Okay.
This is so.
Test, test, test.
This is so.
Test, test, test. Yes, I can. Absolutely.
Yeah, there's a delay. There you go.
Tiny delay, but it's there for sure.
You bought it.
All right, so I need. I'm not sure. I had to mute the Twitch because otherwise it's going to go twice.
No,
You're
you could
fine.
hear me on there though. I think everybody should just mute their voice.
Yeah. Yep.
Yeah. Type it in the main chat. Yeah. Type it.
Alrighty. Hello, everyone. Welcome to the class. We'll start now. So today we're going to be talking about risk management in trading, and I put a little quote here on the first slide. It says, "Experienced traders control risk, while inexperienced traders chase gains," and that's kind of the mindset that we like to be in whenever we're trading, because it leads to like a person being able to trade like sustainably and be around and be trading for a long time. Because if you're not careful, it's very, very easy to blow up your account and to not be in this game for very long. So that's what we're going to try to prevent here, and we're going to try to teach you guys some ways that you can like diversify your portfolio and take smaller position sizes and really pay attention to your risk and avoid having a few big losses that take you out of the game. So some of the benefits of proper risk management. If you're properly managing your risk, you will save money whenever you're wrong. You will not take as large of losses, and it is a lot less painful. So you will have stop losses in place, and that means if you go away from your computer or say you go to sleep or something, you don't have to worry about any open positions. So something I like a lot about this is that whenever I'm trading, I put my stop losses in, and I'm able to go out to eat. I can go to bed. I can work on homework and be trading basically while I'm gone, because my stop losses will take care of my trade for me. And it's really like liberating, honestly, because you don't have to worry about your positions like moving against you too much. If you properly manage your risk, you will not feel as emotional whenever you trade. And that's really important to like your ability to like analyze charts, as well as like your mental health if you want to be in this game for a long time. So whenever this really comes around if you take a big loss. Whenever you take a big loss because you weren't properly managing your risk, for the next maybe couple hours or day or even week, like you don't feel the same, and it will really affect your trading. You'll find yourself trying to do what we call revenge trading, which isn't a good thing, where you're trying to take a larger position maybe to make back the money that you lost. Or say I was long on something and I got stopped out of my long, I might decide just to flip short right away for no reason other than my long got stopped out, so obviously it's going down, right? Well, that's not true. But that's something that even like I, as like somebody who's been trading now for a little bit over 2 years, like I find myself doing. And if you properly manage your risk, you avoid that. So if you properly manage your risk, you will not ever have to worry about margin calls or liquidations. If you are properly position sizing and using stop losses, those words should mean nothing to you. You never have to worry about your liquidations or getting a margin call, or getting online and your account's at zero because you got liquidated overnight because something silly happened. That's not a thing, and that's a really like liberating thing to not have to worry about that. A big one that we've seen recently, you will not have to worry about black swan events. So if you don't know what a black swan event is, you're new to trading. It's like a saying that's in other areas. It kind of came from, there were some explorers a long time ago who had only ever seen white swans, and they went to a new continent or something, and they saw black swans, and it changed their paradigm because it was something that they didn't even know was possible. And it really like threw everything, they had to throw everything that they knew out. So as this applies to trading, we see things like Brexit, Trump being elected was another one. And these are just two examples that I've seen. I'm 20 years old. I've been trading for 2 years. I've already seen two things that have happened that could have easily blown up, a good trader, an otherwise good trader's account in 5 or 10 minutes if they weren't properly managing their risk. So these kinds of things are things that nobody expects, that you cannot plan for specifically, other than managing your risk, which kind of hedges yourself against it happening. And we'll go more into that later. But that's something that you won't have to worry about if you're using your stop losses properly and you're sizing your positions properly. So then again, if you do it properly, you never have to worry about blowing up your account. And this also is good whenever you're trying to figure out if your trading strategy is profitable or if it's not. And if a lot of you guys are new traders, this is something you definitely want to figure out as early as possible, because it really doesn't make sense to trade a strategy that isn't profitable. But unless you get 100, 200, a large amount of trades under your belt that follow the rules of the strategy, there's really no good way to know whether it's profitable or not. So the point under that is any loss of equity, if you're properly managing your risk, any loss of equity is going to happen gradually. And you'll be able to pause your trading and reevaluate your strategy if you notice that you're not trading profitably. So the way I do it, and we'll go into this again in a minute, but the way I do it is 2% loss max per trade. And if I'm trading a strategy, or if I'm trying out a new entry signal or something like that, and say I get 4 or 5 trades in a row that get stopped out, I know something is probably going wrong. And I'm only down 8 to 10% of whatever I had put into that account to trade that strategy. So you don't have to lose your account to know that you're doing something wrong. And like I said, whenever you're a new trader, this is really important, because you're not going to know how to trade profitably necessarily. So you want to make sure that you're kind of hedging against yourself in that way, that you don't blow up your account just because you're not trading a profitable strategy. So the best way to manage your risk is position sizing. So your position size on every trade should be based on the difference between your entry and your stop loss. Your stop loss should be placed at the point where you're wrong about the trade. And this is one of the first things I wanted to bring up, is that an easy mistake that some people will make is they get into a position without deciding a stop loss, and they pick some arbitrary number to trade as their position size, and they will try to manage their risk by calculating how much they're okay with losing, and then they put their stop loss like randomly based on that, even though it has no relevance to like the structure on the chart or any like swing highs or swing lows or EMAs or anything. So what you want to do first, before you even enter a trade, is to decide your entry and then decide where your trade is, where it's wrong, basically, where you decide that, okay, the market is doing something that I did not expect it to do, and I'm going to get out of this trade because of it. So you want to put your stop loss somewhere that makes sense, basically. So after you decide where your stop loss should be placed, then you should calculate how much money you would lose if your stop loss was hit. So something that's really relevant to crypto, and what a lot of people here do, is we use BitMEX, which allows us a calculator. It gives us a calculator to do that exactly. So it will tell you, you put in your entry price and you put in your stop price, and then you can put in your position size, and it'll tell you exactly how much Bitcoin you would lose if your stop loss was hit. And that is really useful. And you can do that without their calculator too. So once you have that figured out, you want to adjust your position size to bring your loss on the trade to a set percentage of your account. So I read a lot of books about trading, and watch a lot of like videos and webinars and stuff on YouTube. And from what I can gather, it seems like the pros agree that, like the pro traders, that you need basically somewhere below 5% loss on every trade if you want to be sustainable. And one analogy that I like to use that might help you guys wrap your heads around this is the idea of flipping a coin. And I tell this to everybody. I say, okay, so if you have a strategy, and we'll say you're trading flipping a coin, and say you make $10 every time you get a heads, and you lose $10 every time you get a tails, right? So if you have $100 account, I'm doing air quotes right now, account, then you can take, let's see, you take 5 losses, right? And you're down, so 5 tails in a row, you're down to 50% of your account. It's like, that's too much, because then you have to, and I have another graphic that shows this, then you have to make 100% of your account to get that money back, and just to get back where you started. So you only lost 50, but you have to make 100% on the 50 that you have now. You have to double it to get back. So to be sustainable, you will take 5 losses in a row at some point, even with a profitable strategy. That just happens sometimes, especially if you're trading for a long time. So to be sustainable, you really need to take smaller than 10% loss per trade for sure. Probably smaller than 5%. To be safe, I do 2%. That's what a lot of other pros do. So then once you've decided what your position size is going to be, that only gives you a 2% loss if your stop loss gets hit, then you can enter the trade. Then you take the trade. So another big problem that I see is that people will adjust their position size based on how good they think a trade looks. And that's not a good strategy. That gives a lot of subjectivity to the person that's trading. And it's really, really dangerous, because there will be times where you'll see, you might see Bitcoin pop $300 or $400 in a single 1-minute candle. And you might think to yourself, oh, this is going straight up. There's no way this comes down, And then you take a big position on the trade, and then it comes right back down. And all of a sudden you're underwater 10% of your account. That's not a sustainable way to trade. And even if it works out, 1 time, 2 times, 3 times, eventually, you're going to go bust if you keep doing that. So, you need to have a systematic, that's the important thing, a systematic way of determining your position size that you do not stray from. Because if you give yourself, and I'm talking about myself here too, if you give yourself any little wiggle room to adjust these kinds of things, you will break your own rules, and it will lead to more losses than you would take otherwise. So, does anyone have any questions on this slide right here? If you do, you can say it real quick, or you can type it in the chat. Nothing? Okay, I'll go on to the next one. So here's what I was talking about with the coin flipping thing, and this applies to trading normally too. So what do I have to do to get back to break even? So if you have a 10% loss of your capital, you need to make 11% on your account to get back to where you were at break even. So the example that I brought up in the coin flipping analogy was a 50% loss of capital. So that's 5 losing trades in a row would bring you down to 50%. And then you have to double your account to get it back. And that's going to be a really hard thing to do, because you're going to have to be trading a very, very profitable strategy, or have a lot of time to be able to make, to double an account. And then it's just really, really bad once you get down to a point to where you're at a 90% loss of capital, 900% to get back to break even. And that's something that you really cannot be having to worry, because if you're having to worry about a drawdown, and this is all called drawdown. So if you get down to a 50% loss of capital, then your drawdown is 50%. So if you have to worry about a drawdown of, even 30% or 40% at any one given time, you're going to have a lot harder time trading, and you would make a lot more money if you just took smaller position sizes. So if you did the 2% rule, it would take 5 losses in a row to get down to 10%, which that could happen. Like I said, it might happen. But then you only need 11% to get back to break even, which is still more than you lost. So it's still kind of the way it works. It's hard to make money. It's harder to make money than it is to lose money. So that's something that you really have to pay attention to. And if you want to read more about that, you can look up drawdown. And even Google searching drawdown of a coin flip is, whenever I first got into this risk management stuff, that's what I looked up, and I found a lot of literature on it, and you can read a lot about it. So in the comments here on Twitch, somebody said hedging. What's hedging? So hedging is whenever you make a bet, essentially, or make a trade, and you protect yourself against loss. It could also be applied to like things that aren't trading, and it's basically just any time that you make a choice, but you want to protect yourself in case you make the wrong choice. So an example of hedging, just in making a trade, an example of hedging would be using a stop loss, because you're hedging yourself against being wrong about the trade. You stop out, you lose a little bit of money, but less than you would lose if you just let it go against you, because it can go on forever. So I hope that answered your question. Let me know if it didn't. So the next slide. So if we look at an example of risking 2% per trade versus risking 10% per trade, you can see that like by trade 3 here, if you start out with a $20,000 account with 3 losses in a row, losing 2% each time, you're going to be down to $19,208. So if you were risking 10% on each trade, you're going to be down to $16,200, and that's a pretty large drop. That's a little bit less than 25%, I think, off the top of my head. So that goes back to like the last slide, and I can hop back to it here. But if you were risking 10% on each trade, and you took 3 losses in a row, you're already down to, what we say, 25%. So let's go back here. So that means you're at somewhere between these two right here, somewhere between 20 and 30% percent loss of capital. So then your percent required to get back to break even is going to be between 25 and 43%, even though you only lost around 25%. So like I said, it's a lot harder to make money than it is to lose money. So you can even see in some bad cases, if you were to have, and this is say if you were trading a strategy that you didn't know was profitable necessarily, you might take 5 or 6 losses in a row on it before you realize it's not profitable. Well, if you take 5 or 6, say you take 6 losses on an account that you're only trading a 2% loss per trade, you're going to be down to $18,078 on that account. So that's about a little bit less than 10% loss on your account. If you were to take 6 losses, risking 10% on each trade, you're almost down, like that's 45%-ish. You're almost down to a 50% loss on your account, at which point you're going to have to make 100%. You're going to have to almost double your account to make that money back. And like I said, that's going to be really hard to do, and it's going to be a lot harder to do than it was to lose that money. So another thing that we'll talk about, that was all the position sizing material. Another thing we'll talk about is the risk management and correlated markets. And this is something that's very, very, very important for crypto traders. This is something that I learned in Forex, which it was a little bit easier to learn because all of the tickers, or all of the pairs that I would trade, so say I'm trading Euro USD, Euro New Zealand, Euro Aussie, then they would say, Euro in all of them. So I know they were all kind of moving together to a certain extent. But in crypto, it's hidden. So it's there, but it's harder for people to see. And I see people make this mistake a lot. So if you have positions open in multiple correlated markets at the same time, which I'm going to say right now, all crypto markets, all crypto coins are correlated to an extent. And I've dated back this up in a minute here. So we'll say, for example, Litecoin against Bitcoin and ETH against Bitcoin. Then your total loss for both trades combined should not exceed the set percent of your account that you decided on earlier and that we talked about earlier. So the reason for this is that coins tend to move together. One part of that is they're all tied to Bitcoin. And sometimes you'll see bad news come out for Bitcoin, and that might hurt altcoins too, even though it has nothing to do with like NEO or something. NEO might go down because it kind of shakes investor confidence in crypto. And people look to Bitcoin as like a metric of how crypto is doing in general. And if you see news come out for Bitcoin, a lot of times you'll see some altcoins move in the same way. So for an example, with just 2% risk on 5 separate altcoin long positions, so what would happen if Bitcoin ran? So all of your trades could go negative at the same time. So this is if your altcoins weren't running with Bitcoin, and this happens too. If your altcoins aren't running with Bitcoin and Bitcoin runs against the US dollar, your altcoins are going to move down because they're denominated against Bitcoin. Your price of your altcoin might be 0.0001 BTC. Well, if BTC moves up, that means the altcoin is going to move down in relation to it. So if this were the case, then all of your trades would go negative at the same time, and you would lose 10% of your account if you got stopped out on all of those. And that's even assuming you follow the 2% rule. So you can just imagine how easy it is for somebody to lose money if, one, they don't follow the rule of capping their losses to a manageable percent, we'll say under 5%. But in addition to that, they're trading correlated markets. And the exchanges, you got to watch out, guys, because they're really set up to make it easy for people to do this. So if you go on something like, we'll say Polo, and you're looking at margin trading, you might have 10 or 15 different coins that you can margin trade there. You can open positions on, and you can open them at the same time. So say you have a long position open on ETH Bitcoin, you have a long position open on Litecoin. You could throw some STR in there. You could do BitShares. Okay, that's 4 positions that you have open. Those can all move in tandem, and you're exposing your account to a lot more risk than it might appear because they will move together. We got another question here. It says, can't you just short one time and go small on a long? Just a second. I'm having trouble seeing it. Okay, there we go. Can't you just short one times and go small on the long, but instead of one times, go with like 50 times with the limit? So if it does go up, sure, you'll lose your short, but you'll make money back with 50 times. Okay, that is something that you can do. On the one hand, that would be risky with, let me see, I'll read it out again slower because you guys actually can't see the chat now that I think about it. He says, can't you just short one times and at the same time go small on a long, but instead of one times, go with like 50 times with the limit. So 50 times margin on a long and 1 times on the short. So if it goes up, you're going to lose your short, but you'll make the money back with the 50 times. So yeah, there you go. So you can do that. One problem I see right away with that is if you're doing, we'll say if you do 50 times leverage, your liquidation price, we'll say on Bitcoin or BitMEX specifically, your liquidation price is going to be very, very close if you're 50 times. So you could, how do I say this? You could have the price swing down against you and hit your liquidation price and liquidate you on the long before the short made that same amount of money. And that might not make a lot of sense, but one thing you'd have to worry about there is your liquidation price. Another thing, because I've seen people ask me the same question in like Forex and stuff. If you do something like that, so you're basically trading the market in opposite directions. On the one hand, you're going to have a brokerage that even allows you to do it. So like if you try to do this on BitMEX, you can't open 2 opposing positions at the same time because trying to open one would just cancel out the other. So on the one hand, you'd have to have 2 accounts to do it. And then you could have a situation where if you use stop losses, it goes up, stops you out on the short, or it goes up, stops you out on the short, and then moves down against your long. I don't know. That's something that is a really tricky thing to do. Yeah, if it was an easy way, I can say this: if it was an easy way to make money, people would be doing it, and it wouldn't work. So even if there's something that I can't necessarily think up to discount that strategy right now, there's got to be something out there. Yeah. Okay. So the next one. So this is back to the correlation of crypto coins. So here we've got a cryptocurrency correlation matrix, 180 day. So if you've ever taken a statistics class, these would be the R values, and basically the like the heat map over here shows you that a correlation of 1 is red and the correlation of -1 is blue. So ideally, in markets that we're trading, if we're trading them at the same time, we'd want to see a correlation of 0. Gray is good here because that means that we're allowed to take multiple positions at the same time without them moving with or against each other just because something happened that affected them both. So you can see mostly here. So this is where the coins end right after Factum here, FCT. You can see the SP 500, and I guess that's the price of gold right there. They don't really correlate much at all with a lot of these things. So there's a lot of gray there. But whenever you look at just the coins, I mean, you can see most of these numbers are at least over 0.5. These, you wouldn't pay attention to these right here because this would be the correlation of the same coin like against itself. So we've got like Bitcoin against Bitcoin. Then if you go down 1/1, ETH against ETH, down 1/1, XRP against XRP. So you can ignore that middle diagonal line because of course they're going to correlate with each other 100% of the time. But with these other ones, this is to the point that you have to worry about trading multiple altcoins at the same time because you're going to expose yourself to a lot more risk than you would think. I mean, one big one here is ETH to Bitcoin with a correlation of 0.6. You'll see, and even if you're not margin trading it, you'll put money in ETH and then put money in Bitcoin also. And if you do that, if like crypto in general, you'll see like bad news for Bitcoin come out, and like all the crypto markets fall, and you could lose a lot of money just off of one like fundamental event. So basically, with this data right here, we can see that we should make sure that all of our positions have a max risk of whatever your percent is going to be. So 2%, 5%, all of your correlated positions. So just all of your crypto altcoin positions should have the max risk of below 5% because they will move against you at the same time. We've got another question here. Trade when an altcoin, he says, trade when an altcoin will move faster than Bitcoin. Is it a good idea to long the altcoin and short Bitcoin since coins move in tandem? Hedging the beta. So if an altcoin is going to move faster than Bitcoin, which a lot of times they do because they're a lot smaller market cap and more volume, if it's moving faster up than Bitcoin, then yeah, it would be a good idea to long the altcoin. Now, if you're longing the altcoin on margin, then you are, like by definition, shorting Bitcoin. If it's against Bitcoin, you're selling someone else's Bitcoin to buy more of the altcoin with. So you're shorting Bitcoin to an extent there. I'm not sure what you mean there at the end by since coins move in tandem. If you want to clarify that real quick, we'll have some time for questions at the end and I can get back to it. But in general, yeah, that's what you're trying to do is if you see an altcoin moving faster than Bitcoin, then that's what you'd want to be putting your money long or short on. All right, so, well, that was the end of the presentation. So we went over position sizing and correlated markets. So those are the two biggest things that I wanted to address here because I see people a lot of times making mistakes with them, and it will blow up your account faster than you think, and that's not what we want to see. We want to see people making money. So, so thanks for joining us. If you have any questions, you can post them like on Twitch chat, like people have been doing, or in the Discord chat, or you can speak up, and I'll answer those. I'll be around here for a little bit to answer questions. And then if you think of anything else, feel free to contact me through PM. If you have any questions on like the presentation material or just trading in general, it's gang affiliated on Discord, and you can send me a private message on there. You can tag me in a message in the main trading room. You can message any of the other mods or admins. We'd all be glad to help you out. So so let us know. So here we got a clarification on the last question. He says coins move together. So we get rid of the market moving together. I just want alpha on the alt. Yeah, so if you wanted to, you'd be betting in that case. So if you're long on the altcoin and you're short on Bitcoin, you would have to be betting that the altcoin moves up faster than Bitcoin does. Yeah, so that That's right. You're right to say that. All right. Does anyone else have any questions, or does anyone want to say anything in voice? Do you have any questions that you could ask me here, or? All right. Check the classroom chat. Yeah, no problem. Retrospects. He says, thanks so much. This was awesome. No problem. Glad I could help. 11930 says on Twitch, have you ever gotten emotional and placed a big trade without any limits? Yeah, for sure. That's something that I did a lot more whenever I was new to trading. That's something that I did in Forex. I mean, there are kind of like some demons that you have to face whenever you learn to trade. And the idea of presentations like this and going out to doing your own research as a trader and reading and watching videos is that you won't have to face those demons on your own, on the one hand. On the second hand, that those kinds of things are going to be issues, and you can kind of work to avoid them or to learn from other people's mistakes and to not make those mistakes yourself. Hopefully you lose less money if you do that. So I can't think of anything specifically where I made a big trade without any limits and lost a ton of money. Because I try to be pretty risk averse myself, but and really whenever you'll see it, it'll hurt you is you might do it a couple times. You might make big trades and not put any stop losses in, and it might work in your favor, once or twice, but eventually you are gonna blow up an account if you keep doing that over time. Because the point of a lot of us trading here is that we want to be able to trade, for a long time into the future and continue trading and continue making money rather than just, quadrupling your account every day. That's not sustainable. As far as I don't know of any good way to be able to do that. So basically, if you're making a big trade without any limits, it could work for you a few times, but eventually you're gonna blow up an account doing that. No more questions? All right. Well, like I said, if you have any other questions you can think of, or just have any questions about trading in general, send me a PM or something, or ask any of us, and we'll be glad to help you out. So thanks for tuning in.